all situations across Australia is a formidable task. But for those that really want some guidance around adequacy of funds, this is a good guide. And just to give you a little bit more detail, you can see from this table here, we've summarised the report, that these are the things that come into what's considered a comfortable retirement versus a modest retirement. And you can see there's a large amount of subjectivity here because there needs to be. But, you know, for example, you can see the wine example. So bottled wine versus cask wine, good close versus reasonable close. So there are some indicative things that we can have that we can point to, but there is a reference there down the bottom. So for those that are interested in more of the detail around how these numbers were arrived at and what are the considerations, we would encourage you just to download that report and you can see the link there. As I say, it is a government report, so it's not a private report with vested interests at all, and it is purely information only. So a good source of information for those wanting a bit more of an indication on adequacy. One of the other things that Tina and the like would be considering when people approach retirement and then go into retirement is to take a holistic view. And Tina, if I can just draw upon your knowledge here on other considerations beyond just superannuation.
For a lot of people, if they have enough superannuation, it's going to be quite simple. They don't have to try and draw on resources from savings that they might have built up. But in reality, sometimes that may not be enough. So if you have been actively saving or investing outside of superannuation, or maybe even fortunate to receive an inheritance, for example, so that might be in form of a investment property, maybe some shares. There's a lot of people with shares that they may have received from some of the companies that have demutualised over the years, like AMP and IAG. And perhaps they've also got savings that they've built up. So we're going to look at all the resources, and that can come into the picture when determining whether there's adequacy to provide for their retirement lifestyle that they want. The other potential asset that could come into the picture is the family home, and not necessarily as an objective to be used as the retirement asset, but for many people it may be that as they are getting older and their home is large and they're looking for a lower maintenance property which may cost them less, the surplus from that changeover could also form part of their retirement funding, whether that is a deliberate goal or it could be just that it happens that way. So we're going to take that into account when we're looking at whether that's going to help them support their retirement.
Thank you, Tina. And one of the other considerations, of course, is tax. And this is one of the huge benefits of superannuation. So just to clarify what's on the screen, when you're investing in superannuation, there is a tax on the investment earnings of up to 15%. It can be less because of imputation credits the fund may receive, but it's up to 15%. And when you enter into the retirement phase and you typically move to an account-based pension and you're over 60 typically, you would be in a zero tax environment. So just to give a bit of clarity to the tax situation, think of it as in accumulation, it's 15% on earnings. And once you go into the drawdown phase, and typically, as I say, you're over 60, it'll be a zero tax environment. There are these three areas that we talk about when we talk about approaching retirement, and there are a few nuances in that under 60 bracket in particular. Tina, can I just refer to you on this, just the key issues for particularly those under 60 and those over 65, if I may?
Certainly. The previous slide shows the tax that applies to superannuation investments. And as you can see, it is a lower tax environment than if you invested outside of superannuation. So we often use superannuation as the vehicle to try and build the retirement savings. But of course, a lot of people are also interested in, if I did build my retirement savings through superannuation, when can I access that? Because that's going to be critical to understand when you're looking at stopping work. So with superannuation, there's condition of release rules. That's basically defining when you can have access to your superannuation. And it's determined by age. The terminology is used as called preservation age. So you can see in this slide, between age 58 and 59, you've reached preservation age. However, if you're still working, then you haven't met a full condition of release for superannuation. So you can have a transition to retirement access, which is a limited access by way of starting a transition to retirement pension. The age between age 58 and 59 condition of release for retirement is defined as stopping work with an intention to retire. With the age from 60 onwards to 64 years of age, you don't actually have to intend to retire, you just have to terminate an existing employment arrangement. So that's stopping a current job and going to another job. It doesn't apply, of course, if you're working for the same diocese, because you're still employed by the same employer. So that's particularly important to understand for people who are working in the Catholic education. And then from age 65, you've met a condition of release regardless of whether you're working or not. So you have unrestricted access to your superannuation. Now, just because you have reached those ages and you can access your super doesn't mean you should. If your objective is to be building your super to accumulate for retirement, then it may not be appropriate to start an income stream. When we're providing advice, we're looking at the whole situation and determining if it's strategically beneficial for you to start an income stream to assist you in maybe debt reduction or in being able to increase salary sacrifice. But that's just good to understand if you're concerned about when you might be able to have access to your super.
Just in terms of money going into your super from your employer, just to remind people that the rates are increasing, and you can see there how they've been progressively increasing, and they will increase to 12% by mid-2025. So the government has this legislated, so we are going to enjoy further contributions from our employer as the years roll on, as you can see there. One of the other considerations, though, is salary sacrificing on top of those requirements that we've just looked at, those percentages. One of the big incentives to salary sacrifice is you will substitute your marginal tax rate for a contributions tax rate of 15%. So, for example, if we take a typical worker who's on the $45,000 to $120,000 income bracket, if they have salary and earnings sent to their bank account, they would be paying a bit over 32% in tax. Whereas if they salary sacrifice some amount, instead of being taxed at that level, it would be taxed at 15%. So there's an obvious 17.5% saving to be had. If there's a downside, it is for those in the younger age ranges, they can't access the money until obviously they reach preservation and have met certain conditions. So while we do naturally encourage people to save in superannuation and salary sacrifice, that's one of the key considerations. If we actually, Tina, could you walk us through this example if you would?
So the tax brackets, as you can see in the last slide, gives you an idea of what the tax differential between your marginal tax rate and the superannuation contributions tax rate when you salary sacrifice. And this is an example specifically for someone who may have a salary of 100,000. So we've worked it out on a fortnightly basis on that first line. the gross amount that's before tax is $3,846. Now compare the columns on the left side, that's essentially not making any extra salary sacrifice contributions. Your take-home pay after income tax is 28. I'm just going to make it a little bit larger, 2884. On the right-hand column, the example we have is if you were setting up a salary sacrifice arrangement and got your employer to put 5% into superannuation, that's $192 a fortnight. What that then does is that your taxable income will drop by that amount, and the income tax will be applicable to that taxable income. So your take-home pay will drop down to $2,757. So that's a difference of $127. So you're giving up $127 a fortnight, but what you'll get is more in superannuation. It's $66 more in superannuation than you would have got if you took the money home. And that advantage, as you can see, can be substantial when you compound it over many years. So for example, the tax savings in this 5% example is $1,716 per year. Do that for 10 years and take into account that there's going to be investment earnings on top of that. It's a very simple, tax-effective way to build up your retirement savings through the salary sacrifice strategy.
Thank you, Tina. And salary sacrifice, of course, as employer contributions and SG that we've just looked at, are what's considered a concessional contribution. So concessional contributions are those that are taxed at 15% on the way into super. And the reason they're called concessional is because you're obviously not paying your marginal tax rate on those. So as you can see there, this includes employer contributions, super guarantee contributions, salary sacrifice, additional employer contributions, and what we call personal deductible contributions. So where you make a contribution and you subsequently claim a tax deduction for it. The current limit on the amount of concessional contributions you can make is $27,500 this financial year, although you can use what we call an unused amount from previous years if your balance is under 500,000. If you have further questions on that, please feel free to ask and we'll be able to get you further information. When we talk about non-concessional contributions, this is money you're putting into super that's essentially in your bank account. So you've already paid income tax on this money. So as you can see there, the amounts and the allowances are far more generous. So if you're under 67, you can see there you can put in 110,000 a year. And you can use this 3-year provision if you like. So in a single year, you can put in 330,000. However, it does prevent you putting in money in year 2 and year 3 because you've used up your 3-year allowance. As you can see there, if you're aged between 67 and 74, no work test applies, so you're free to put in up to 110,000. However, once you're at 75 years and more, you're not able to contribute what we call non-concessional contributions. The thinking there is you're well and truly in the drawdown phase, so it's time to start enjoying your money essentially. So you are then going to be more than likely in the allocated pension scheme and drawing back on your funds rather than accumulating. Other ways to contribute to super, and you may have heard these, downsizer, and I will ask Tina to speak about this one in a moment. This is becoming increasingly popular. Spouse contributions, and we do always encourage people to consolidate their super where possible. The main consideration there, of course, is just ensure that you're not cancelling any essential insurances by doing so. But Tina, if I can just throw to you on this one to speak a little bit about downsizer and spouse contributions, if you would.
Hi, Matt. Well, thank you.
Certainly, the ways to contribute into superannuation is probably where there's a lot of confusion, and also legislation has changed over the years. So it's really important when you are making, or when you're in a position where you have surplus income or lump sums and you would like to use the superannuation to invest that money, to understand what are the options and is available for you to put that money into superannuation. As Wayne has explained in the previous slide, there was the option to salary sacrifice. That's applicable for someone who's working, who has a marginal tax rate that is higher than what it would be for a superannuation contributions tax. But if you're not working, then the salary sacrifice is obviously not going to be tax advantageous, or not applicable to you. But the personal contribution and those limits that apply for personal contribution and the ages need to be taken into account. But let's say that you're outside of those age, or let's say that you've sold your home and there's surplus money left over from that sale and you would like to invest that into superannuation, it is possible under the downsizer contribution rule. With the downsizer, that's relatively recent legislation change to superannuation. So again, it's important to understand the rules, but it became available for someone who's over the age of 65. They've sold their principal place of residence, that's the home they live in, and they've got surplus money that they would like to invest in superannuation. So it is possible to make a lump sum contribution under the downsizer. There is a limit to that. There's always a limit to contribution, so it's important to understand those limits. And that's $300,000 per person. There are some other rules that you need to understand as well. So if you are going to be looking at making a downsizer, I'd suggest you get advice, and then we can confirm if you're eligible. The other ways to contribute to superannuation, the spouse contribution, that's probably one that not a lot of people are using, but and that could be because it's not necessarily as appropriate for the situation. So with the spouse contribution, it was a rule to allow you to make a contribution to a low income earning spouse, and as the contributing spouse you get an incentive, and that incentive is in the form of a tax rebate. That tax rebate only applies to a contribution up to $3,000. You can contribute more, but the rebate only applies up to $3,000. And again, it's important if you want to look at doing something like that and seeing what the advantage might be, to get advice, because there are some other rules to understand in regards to whether there is the eligibility for that rebate.
Thank you, Tina. And of course, just covering preservation age. So this is a progressive thing, obviously, so dependent on when you were born. And as you can see there, if you're born in the early to mid 60s, it varies, but once you're born after mid 64, it's essentially age 60. So increasingly, we will see people have preservation ages consistently at age 60 fairly soon, but we are still in this transitional period, if you like. But if you're ever unsure of what your preservation age is, you only need to have a look at those dates of birth and just understand which category you fit into. In terms of accessing your super, there are two ways you can do it when you're eligible to. You can take lump sums, or alternately, you can take income streams, or you can do both. And many people, for example, will go into retirement, they'll require a small lump sum, perhaps to update the car or do home renovations or something similar. And then they will draw a regular income stream. And that's usually drawn down on a monthly basis, and that's usually determined by the adequacy of what they need and also with consideration to the size of their superannuation. So, and that's all done tax-free. So a very, very flexible arrangement once you go into that phase. As I say, just to continue that theme, so when you're in super, you're in this accumulation stage, as we call it. And you can see there on the left how the funds enter superannuation, and it is taxed, as we mentioned, up to 15% while in superannuation. However, once you move into that drawdown account and you're eligible to take either lump sums or pension payments, the earnings and any lump sum withdrawals are tax-free. Transition to retirement is a popular one, and this is a situation where you've got someone who's working, so they're contributing to super, but at the same time they're drawing down on super. And you might ask, well, why would you do that? Well, essentially, it's a tax strategy. So you'll be salary sacrificing, as we looked at, but you'll be also getting money out of your super in a fairly tax concessional way. So as you can see there are some limits imposed upon this strategy. So the maximum you can draw down is 10%. And obviously there are limits to how much you can salary sacrifice, because you've got that ultimate concessional contribution cap of $27,500 per year. But for those that are interested, particularly those in their 60s where they can draw down from super tax-free, this is a particularly effective strategy. And I'll just ask Tina just to provide a couple of comments on how common this is and how she advises people around it.
This strategy is utilised for a number of reasons. One of the reasons you mentioned before, it's a tax strategy, is whereby if a person is in a situation where they cannot afford to salary sacrifice up to the available cap, because that would mean that they wouldn't take enough money home to live on, then it's a way in which we can restructure their salary by taking advantage of that cap, meaning that they salary sacrifice up to the threshold. So they're getting a tax advantage through the salary sacrifice. And then if there's a shortfall in the take-home pay to meet their living expenses, then the accumulated superannuation could be used to create that transition pension. And if they're over the age of 60, that income from that pension is tax-free. So it's a very effective way to restructure the income from wages to maximise the pre-tax contributions to superannuation, which gives them a tax advantage and is boosting the contribution to super. And then replacing that shortfall of income with a tax-free income from that transition pension. So that can work in certain circumstances. It doesn't always work, and we're going to provide personalised advice when we're looking at a member's personal situation to see if there's an advantage, because that will help them to grow their superannuation more effectively without necessarily reducing their take-home pay. The other time we might use this strategy is not for tax reason, but it's because a member might be wanting to cut back their hours, but they can't afford to do that because the wages may not be sufficient to meet their living expenses. Then a transition pension would supplement that. But it does mean that you're not growing your superannuation. It might be stagnant. It might even be going backwards if you're drawing more than what's going in.
Thank you, Tina. When you're past that transition to retirement stage, you move on typically to a full allocated pension. And this is a situation where you are fully retired. So this is your main source of income. It could be being complemented with the age pension, which we'll talk about shortly, but essentially this is where you're no longer working and you're drawing down on your superannuation. So there are minimums in place in terms of how much you are required to take, and that currently is 2% for those under 65, and for those 65 and above it's 5%, and it progressively goes up. However, we do have this unusual arrangement at the moment where for the current financial year, you can take half of the required minimum if you wish. So the minimum of 4% and 5%, etc., can be reduced or is reduced by 50%, if that makes sense. It will revert to the normal 4% minimum drawdown and 5% minimum drawdown, etc., after this financial year. But as I say, we're in this unusual period at the moment, and it was largely because of COVID, and people were anxious about earnings rates and superannuation, and also they just weren't spending quite like they plan to, for obvious reasons. There is no maximum, however, that you need to take from your allocated pension. So that's the important point to note. And there is always flexibility with the allocated pension in terms of being able to take lump sums if you wish, as well as the regular pension payments. In terms of the product offerings we have, one of those is called RetireChoice. And as the name implies, it allows you to choose where your money is invested. And essentially, people are often choosing between what we call diversified funds, which you can see on the left-hand side there, that consist of the various asset sectors, or you can choose single asset classes, as you can see there on the right, where you can nominate, for example, Australian shares or property or bonds or whatever it may be. So a lot of people will have a mix and match if they're going down this road and they wish to choose their asset allocation. But you can have as few of these options or as many of these options as you wish. It is completely up to yourself. However, it is fair to say a number of people don't wish to make this choice. So for those that don't wish to make the choice of where their money is invested, we have what's called RetireSmart, which is essentially a mixture of the various asset classes based on your age. So it's a formulaic approach to maximise growth, if you like, while minimising volatility. And the idea behind it is you have this, what we call, two-bucket investment approach, where you have a growth bucket and a cash bucket. The idea being that the cash bucket is where you take your pension payments from, and the growth bucket is the area that generate the distributions that create funds in that cash bucket, if that makes sense. So yeah, this approach, also known as Lifetime One, is very, very popular because it takes some of that, takes that investment decision process away from individuals, because often they're not comfortable to make it. Tina, if I can just refer to yourself, in practice, what are people's responses to RetireChoice versus RetireSmart, and what's your approach?
I think what I'm seeing when people are coming in, it's because they don't fully understand, or they're not comfortable, or they feel like they need some help with regards to the product choices. So that's where advice can be really valuable, because we will firstly provide them with some education so they can make an informed choice, but we'll also help with explaining the risk and return decision that they need to make. So that's relevant to the RetireChoice allocated pension, because you have to make a choice out of those investment menu, and we can help you make that choice by providing education and also using our professional understanding of the risk and return to explain to you so that you can make an informed choice, and then we can provide a recommendation for the investment options that are going to suit your risk profile. That's for the RetireChoice product. The RetireSmart product, you don't make an investment choice, but it's important to understand that risk return outcome based on how the monies would be allocated between the growth bucket and the cash bucket. And depending on when you start your allocated pension, how much pension payment you're going to be drawing down and how quickly you will be drawing it down, that will determine how much will go into the growth bucket, the cash bucket, and that drives the risk return outcome. So again, it's important that you understand that, and we're able to help with that to provide a recommendation on which product option will align with your risk profile.
Thank you, Tina. And one of the obvious questions people have is, when can I retire? We've talked a little bit about when can you retire, but often people are confusing when can I retire versus when can I access my superannuation. if you've got adequate resources, you can retire whenever you like. But if the question is, when can you draw on your superannuation? Well, then we come back to preservation age and what we call release conditions. Do I have enough? We've spoken a little bit about that in terms of the ASPA guides around how much income typically is thought to be required, and therefore what lump sums are required to support that. And the other thing that's recently come into the mix is obviously COVID, because people's spending patterns have needed to change and have been forced to change dramatically over the past couple of years. So for many people, obviously they're not traveling and they're not spending quite as they plan to. So their funds could potentially last longer, particularly given that the minimum drawdown has also been halved. So all of that provides well for adequacy into an older age, if you like. We've got an example here that I'll ask Tina to assist and talk through, but essentially we've got Mr. Gary and Mary as clients, 65 years of age, $300,000 each. They own their home. They deem the income required is $63,000 per annum, which obviously is quite high based on the ASPA suggestions we saw earlier. They don't have non-superannuation investments. We're assuming a rate of return of 5%, an inflation rate of 2.5%, a rising living standards of around 2.5%, just to guard against that inflation risk. And what we're going to show you is expressed in present value, not future value terms, so it's more relatable. But I'll just refer to the following slide here. And Tina, if I can just ask you to explain how over the course of aging, your funds essentially run down.
We can start. We can see the starting position at 600,000. That's at the top of the graph from age 65, and there's a graduated reduction over time. And in this instance, the funds are completely exhausted and used up by age 93. Now, what's included in these assumptions is that you're drawing money from your superannuation to live in with a target of $63,000 per annum, and that's inflated by 2.5%. And that's going to be met initially with your just superannuation, but as the clients move into eligible age pension age, they're getting partially some income support from the age pension, which means drawing less of their own money. And that's sort of increasing over time. So over time, they're drawing less of their own money to meet their income requirements, and because age pension is funding more of it. And that allows that money to be lasting a lot longer than most people would have thought. There's the figure of $1 million. You need $1 million to retire floating around for retirees to be targeting. But if your income requirements are not as high, then you don't need as much. And we also factor in that there would be eligibility for age pension, which can come into the picture, and that allows those funds to last longer. So that's what this calculation is illustrating, that 600,000 for a couple who are retiring at 65, aiming to have an income of $63,000 per annum in today's dollars, could potentially fund their retirement up to age 93 with 600,000.
Thank you, Tina. And if you could just talk to this one as well, which complements the income, as you can see there with age pension.
Yeah, so we can see that example where I mentioned the red line is where that 63,000 figure is, and the purple bars are what is being drawn out of the superannuation, and the blue is what is being provided by the age pension. So there is a point at around the age 71 where age pension has reached the maximum, so you're not going to get any more from the age pension. And that is probably around 55% of the requirements. So for a $63,000 living expense, the age pension is providing about 55% of the requirements, and their own superannuation is providing the other 40% of the requirements.
Thank you, Tina. And that leads us on to age pension, eligibility and how we assess it. And just a broad overview here, it's obviously age dependent. You need to be a resident. There are both an asset test and an income test, and we'll look at those, and we'll talk about the payment rates. So you may have noticed that the age pension age has been increasing from the traditional 65 to 67, and it does move to that, as you see there, on the 1st of July 2023. So again, it's a transitional thing at the moment, depending on when you were born. So hopefully you can see there when you'll be eligible for age pension. But what it does mean, like the previous example, if you choose to retire before you're eligible for age pension, you will be fully funding your retirement, if you like, in those pre-age pension years. If we have a look at the assets test, now the assets test, broadly speaking, covers everything other than the owner-occupied dwelling, so the family home. So if we look at a single homeowner, you can see there, once your assets get to 593,000, there is no pension available for you. And this does include, I should say, it does include superannuation assets. As a single non-homeowner, the allowance is obviously much greater, as you can see there. You are eligible for at least part pension up to 809,500. If we look at a more common occurrence, the couple homeowner, this is where you can have assets of outside the family home of up to 891,500 before you're no longer eligible to receive age pension. So many people receive part age pension. Not so many receive full age pension, because as you can see there, to receive full age pension as a couple homeowner, you would need assets not exceeding 405,000 outside of the family home. And again, for a couple that don't own their home, you can see the allowances are obviously more generous because they're funding a rental. Presumably they're funding rental as well. On the income test side, and it should be noted, most people are impacted by the assets test rather than the income test, but nevertheless, the income test, as you can see there for a single, essentially means once you are earning close to $55,000 or more, you won't be eligible for age pension. And for a couple, as you can see there, once you're earning over 84,000, then essentially you won't be eligible for the age pension. So there is what you would call a reasonableness test on the age pension on both your assets and your income. And it's worth noting that Centrelink will take the test that minimises the pension payment to yourself. So I want to emphasise that point. Both tests will apply, but the test used will be the one that minimises the age pension payment to yourself, not maximises, minimises. So the Centrelink pension rates, as you can see there, are for a single, these are the maximums, 25,155 for couples, and couples combined, 37,924, or couples that are apart due to ill health, and this can happen particularly when we talk a bit later about aged care, it's back to the 25,155. Tina, is there anything I should add that I haven't covered off for eligibility on age pension, or does that pretty much summarise it?
Yeah, I think what a lot of people might not be aware of with regards to the assets test, the personal assets that they have. So that's, the personal contents, your car, or if you've got a caravan, all of these assets are also included in the assets test. But what is the value that you're required to put down? This is where some people are potentially doing themselves a disfavour, because they sometimes put the actual insured value, or, and we know the insured value is a new replacement value, which is not necessarily what Centrelink is asking. They're asking for the second-hand value. So it's important when you're putting the valuations for these non-financial assets that you don't overvalue it. Put the cash value of what that item would be if you were to sell it on second-hand.
So they've built up some equity in their home and can finally upsize. Yeah,
if I can just ask, I think someone might have their microphone open. If they can just mute it, that'd be terrific. We're just getting a little bit of sound coming through. The other thing too that people often ask when it comes to the age pension is the Commonwealth Seniors Health Card. So there are a few tests around this, a residency test, an income test, that you've reached age pension age, and you can see there are limits on income, and it can lead to cheaper medicine and bulk bill doctor visits, as it says there. These are all Commonwealth responsibilities, you'll note. There are state-based seniors cards as well, and we'll address that in a minute, but here we're talking about Commonwealth. Tina, just a couple of the considerations around this. I'm assuming this would come into the discussions quite a bit when you're talking to people entering retirement.
I mean, when we're providing advice, we're looking at it holistically. So we're trying to sort of maximise all the resources that are available to help a member support their retirement. So if they're eligible for the age pension, we're going to look at strategies and determine what that eligibility might be to help them support their retirement, and their superannuation will provide the supplementary amount to bring it up to the level of lifestyle that they want. But if a member is in a situation where they're not eligible for the age pension, the Commonwealth Seniors Healthcare Card can help with reducing the cost of medicine, and that's that's available to a lot of people because the Commonwealth Seniors Healthcare Card is subject to an income test only, not an assets test, and that income test is reasonably generous. What people might not understand is that it's not what you actually draw out from your allocated pension that is calculated as an income. Centrelink has a different methodology, and it's based on the deeming rate. So you can have quite a large allocated pension and still be under those income thresholds for the Commonwealth Seniors Healthcare Card.
Thank you, Tina. And as mentioned before, the state and territory governments also offer some concessions and some cards that are available on the services they operate, which is typically the utilities and the transport area. So depending on what state you're in, these can vary a little bit, but essentially you would expect some concessional rates around those things. And as Tina mentioned, and we will come to the importance of advice, but you've just heard how when you are working through age pension eligibility, advice matters. Because there are quite a few traps for people if they're unsure how to value things and are a little unsure on what's included and what's not. Moving towards estate planning, naturally enough, we would always encourage people to have a valid will with an attached power of attorney and often an enduring power of attorney. Likewise, we would always encourage people to nominate beneficiaries, whether they are binding or non-binding, but nevertheless provide the trustee of the super fund with some direction, essentially. So you do have some control on your passing of where the remaining funds in your typically allocated pension will be directed. Aged care is one of those areas that increasingly is becoming more and more important. And you would have noted from recent commentary over the last couple of years, there was a Royal Commission. There's been numerous reports on facilities and how they're battling. And it's all around really financial adequacy to ensure that in your older years, you get the best support possible. But it is a complex area. Tina, if I can just refer to yourself on this one and just some of the conversations you have with members and some of the considerations and concerns they have.
I have to admit that I guess aged care is something that most people don't want to think about. So they're not necessarily wanting to ask about it. They might need to ask about it if they are power of attorneys for their parents, for example. Obviously, what we're finding is that people are living longer, and retirement adequacy might mean that they're using up their superannuation over their retirement. Is there going to be a big enough buffer to provision for the cost of aged care? That's really tricky because depending on what you want, if you want to be able to have the most choice with regards to aged care, then you're going to need more resources available for your retirement. And that means that if you're in a situation where you're using up all of your resources to fund your retirement and there's not a lot of buffer, then it means that you're not going to have as much choice when it comes to aged care. The important part is really to have an understanding when you're retiring what you have available, what your spending will do in terms of running that down, and then reviewing it and monitoring as you go along. For a lot of people, it often means selling the home in order to fund aged care. There's some complexity around some impacts on age pension, and we can provide help with that, but for the most part it will be usually the power of attorney that might be coming in to get advice for aged care for their parents.
Thank you, Tina. And just following on from that, Tina, some of the ways planners are able to assist, not just with around the aged care discussion, of course, but on pretty much all the topics we've discussed today. Tina, if you can just talk to some of these points on where you help people the most.
So we have a comprehensive advice point of view when we're providing advice. It's not just looking at your superannuation. We're looking at the big picture in terms of what your retirement goals are and what resources you have available to currently and what you can do to build that up. In terms of how that translates into advice, it's looking at strategies to maximize the growth of your resources, the retirement savings. It's looking at managing your expenditure so that you can ensure that you have sustainability. So that's through our financial projection tools. It's also helping people articulate what their goals are, because that's one of the things that a lot of people struggle with. We're sort of focused on short term, but we're not able to sometimes have clarity on the long term. And so sort of having some goals and quantifying that is really going to help give you a sense of direction, which I think a lot of people value, because then they can see how things are going in the future and have a little bit more peace of mind that they've set themselves up to be able to support that in the most effective way. The other part of advice that is often neglected is the estate planning side. Now, what does that? We don't provide advice on sort of setting up wills, and so we don't set up wills and power of attorneys. That's through solicitors. But where we can provide advice is to look at how you can structure your superannuation or other assets to make it as effective as it can when it passes on to your beneficiary, in terms of minimising any loss of taxation or making sure that it goes to the right beneficiary. And lastly, there's the option for some people, they're not or they have more than enough funds in terms of contributing into superannuation because they've reached limits or age or restrictions, and they would like to get their money invested and working a bit harder. We can also provide advice on investments outside of superannuation where it's appropriate. And that includes looking at yourself, if you're a member, and if you're married and your partner is not a member, we're able to provide advice on other superannuation funds, not just limited to Australian Catholic Super.
In terms of not just how the financial planners can assist, but we've also got regional managers like myself. We've also got call centre staff who are certainly able to help with, general super and pension questions, whatever forms you may need or account information. We've also got a financial projection tool available on the website. There are quite a few of these around. MoneySmart, for example, the government website, has some terrific calculators on it as well. and we always encourage people to use those just to get a sense of adequacy in retirement. But as I say, there are all sorts of resources you can draw upon as a member of Australian Catholic Super. The over-the-phone personal advice team can assist with your superannuation specifically, so your contributions, where your money's invested, what insurances you've got, and also those transition to retirement arrangements. And if you do wish to get some what we call limited advice, then please feel free to let us know. Additionally, you can call the fund on the 1300 number you can see there, or you can let us know via the portal as well. Comprehensive personal advice refers a little bit more to what Tina's been talking about, and where she's able to tailor a full financial plan considering all your assets beyond just your superannuation. So this is where people such as Tina can add real value to people's retirement, because they do know all the obvious tips and traps, and they're able to structure things in the most effective manner. Tina, just if you would, just talk to a couple of the key points, if you would, on ways to I guess benefit members the most, if you could.
Certainly, I think the first thing is really having a sense of where am I at, and that's sort of what I would call a financial assessment. So we can provide that with an initial meeting, and that's really a financial assessment. I would say is sort of having a marker and looking at, okay, this is where I'm at, this is where my assets are at, this is my current work situation, and then goals in the future. And we can then identify what are the relevant financial advice areas that we can help you with to get you from where you're at today to where you want to go into the future, by looking at all of those matters that are going to help with regards to getting you there. So that could be making sure that you're managing your expenditure and making the most of any surplus income to build that retirement savings, and doing it as effectively as possible by minimising any leakage to taxation. In addition, making sure that you're making an informed investment choice, because the result of that money being invested in the returns is going to impact you directly. So it's important to make sure that whatever money you've saved is working as hard as it can for you within your risk profile. The other thing that I think people really get a lot of value from the comprehensive advice is looking at the big picture, seeing where they're at and the direction that they're heading, and having that peace of mind that it is going towards their goals, and they've got a time frame around it, they've got a structure around it, and they know that it's working as effectively as it can for them. But it doesn't mean it's set in concrete, because it's dynamic. You need to review that and see how you're tracking.
Thank you, Tina. And as mentioned earlier, we always encourage people to use the member portal and also to download the phone app, which we've now got available. So you can get all this information very, very quickly and very, very easily. And the member portal can really be the gateway to all the services we offer. So whether you wish to make a contribution, get your balance, change investment options, have a look at insurance adequacy, nominating beneficiaries, you can do a load of things via that portal. So as I say, I know I sound like a scratched record, but I do encourage everybody to make full use of the services that are currently available, and also to download the phone app. So you'll have all the things at literally a couple of taps on the phone. So in terms of what you can do right now, it's obviously make use of the phone app and the portal. You can speak to your local RM, such as myself. You can be talking to the financial advice team, which consists of people such as Tina, or you can be contacting us via the call centre. It's completely up to yourself. We're at the point now, though, where I'm going to circle back in with Justin just to see if we've had any questions come through, and if so, just to make sure we've answered them adequately. So Justin, if I can just bring you in at this point.
Thanks, Wayne. Yeah, you've had a few questions come through the chat box. Most of them have been answered through your presentation. So you and Tina have covered pretty much everything our members have asked today. There's just a couple which I will ask you to further clarify. A member has asked that they are 65 with a transition to retirement. Are they able to take a lump sum out? Can I push that to you, Tina?
Certainly. The transition to retirement pension is a pension that they would have started before retirement, or actually 65, because the condition of release for superannuation defines age 65 as meeting a condition of release, even if that member is still working. So once you meet a condition of release, that is retirement or reaching age 65, your transition pension is automatically going to be revert to a retirement pension or an allocated pension. And in that situation, you have unrestricted access to the funds, and it means that unrestricted means that you can draw lump sums, and you can also have income amounts that is above the 10%. The main thing you've got to obviously be aware of is that if you draw the more funds out, your superannuation pension won't last as long.
Thanks, Tina. And one I get regularly, and I quite like this one. Can I go back to my old job after assessing super, or do I need to find other employment?
So when you say going back to your old job, if you have left employment and terminated an arrangement, that's the terminology used, particularly, this is applicable from age 60. If you've terminated an employment arrangement and you might go back to an employer, but it's on a new employment arrangement, then you've met a condition of release and you can access your superannuation, and it doesn't matter that you didn't intend to retire. This is from age 60. It's a little bit different when you're 58, between 58 and age 60. If you have terminated an employment arrangement, you also need to declare that you intend to retire. And so there should be, I think, a period of time where it's clear that you did intend to retire. It doesn't preclude you from working again, but it should really pass the smell test that at the time you access your superannuation and you sign the declaration, that it was your intention to retire.
Great, thanks, Tina. That was all the questions that have come through so far. So I'll hand back to you, Wayne, to wrap things up. Thank you.
Thanks, Justin. Well, thank you to everyone for attending today. As I mentioned at the beginning, this will be available by the end of the week via YouTube for those who wish to view certain parts again. For those that do need or wish to reach out to any of us, please do so. You've got all our contact details. So hopefully that was informative, and we look forward to speaking to you all soon. So thank you once again.
Thank you.